Hello and welcome to a brand new show of Market Makers. 2017 was supposed to be a dull year, but it has turned out to be a dream year. In the first 3 months, a little less than 3 months, benchmark indices have registered double-digit gains. The small and the mid-cap indices are sitting at a record high. Global markets also are moving from strength to strength. So what is the secret sauce here? Growth concerns, they are still there, and at a time when earnings recovery is debatable, what is fueling global and Indian equities higher? Let's discuss that. Let's talk about that. Let's talk about some mega trends and understand some new pockets of opportunity in this rather bloated market. To discuss that, I have with me Nilesh Shah of Envision Capital. Nilesh, thank you for joining us. The bulls would say it's liquidity. The bears would say shrug it off. It's all euphoria. Markets will come down. It's been a dream year so far.
Yes, I think it's a combination of both because I think global liquidity continues to be very, very strong. I think we in India are fortunate to have a combination of both global liquidity and domestic liquidity, and that's essentially basically driving markets higher. But I think as we say that, we need to keep in mind also that what it looks like and what's driving this, I think is that probably the world itself, I think, is coming out of a 8 to 9 year kind of a slow growth period. What started off as a recession is finally coming into slow growth. And maybe it looks like, especially with what the US Fed is doing in terms of interest rates, it looks like that global growth could be a lot better over the next few years versus what it has been over the last 8 to 10 years. And I think that could be an important change as far as the way forward goes.
Okay, so let's talk about the concerns which were there when we rolled over from 2016 to 2017. Unpredictable Trump regime, it is unpredictable. A drop in demand because of demonetization, the recovery has not happened, and slow recovery in aggregate numbers. So the basic concerns which haunted us, they have not got addressed. Let's be real. And yet markets have managed to climb the wall of worry. Now it's easy to say that it's because of liquidity, but some would argue that's a very shallow argument.
So yes, I think those concerns remain, but maybe the extent of those concerns are not as high as what they were expected to be. So maybe it's when we kind of were towards the end of 2016, it looked as if there would be a huge dent in terms of our GDP growth, and it would take some while for demand to come back. But what we've clearly seen is that remonetization, in a way, has happened a lot faster than what one could have envisaged. And I think that's the difference. So the impact is not as much as what we thought. And in fact, there are enough reports and studies to suggest that our growth had already slowed down in the first half of this financial year. And it had already slowed down even before demonetization had happened. It's just that demonetization happened. We hit some kind of an air pocket for a couple of months, and now it looks to be back to normal. Though, of course, you can't say we're back completely to the normal, but it's definitely not as bad as what one thought it would be in November, December period post the demonetization. So I think that is the change versus what it was 3 to 4 months back. And on top of that, liquidity has been the icing on the cake. But in terms of the other concerns, I think those concerns remain. So I think there were expectations that the Trump administration would go ahead and do tax rate cuts. That's really not happened. The US Fed continues to follow a tightening policy. Back home, we are still in that 6 to 7% growth. We have not yet moved into the 7% growth. Stock prices and market indices are at a record high. P multiples are virtually at a 5 to 10 year high. The mid-cap space is trading at an unprecedented premium to the large-cap space. So, of course, if you look at price and valuations, I think that remains the backdrop, and one has to basically look at the future, keeping this backdrop also in mind.
So, is there money to be made here? Because even if earnings recovery has to happen, it will not be a J curve. It would be a gradual glide up. Stock prices are maybe pricing in a good FY18 and an optimistic FY19.
Well, I think there could still be money to be made from a 2 to 3 year perspective. So I think ideally...
Why is that?
Because I think what you're going to see now going forward is that I think the overall shape of the economy itself will change. I think initiatives like demonetization, GST, etc., I think will change the way the economy itself is constituted, which means that the share of unorganized, which I think has been very high, I think that will kind of come down significantly, and you're going to see the organized players be able to be the larger beneficiaries of these big initiatives. So I think that itself, I think, is going to change, number one. Number two is, I think manufacturing itself could get a huge leg up with GST coming in and with some improvement in infrastructure. I think manufacturing itself could get leg up. And if in the rest tenure of this government or in the start of the next tenure, if reforms like labor reforms and all of that materialize, then I think manufacturing itself could get a huge leg up. So it's quite possible that we have been virtually in a period of the last 8-10 years of single digit earnings growth, that 8-9% earnings growth. Maybe because of all these initiatives and some of the other sectors coming to the fore, it's quite possible that our earnings growth over a 2-3 year time frame, I think, could be a lot higher. So if we've been growing at 8-9%, it's quite possible earnings growth itself could move into a 15 to 18% kind of a CAGR situation over a 2-3 year time frame. It's hard to say whether it will start in this financial year or not, but I think over a 2 to 3 year time frame, I think earnings growth could be a lot higher versus what it has been over the last 5 to 10 years.
Okay. Now IT companies, they are considering a buyback. Infosys may consider one, HCL Tech will announce in the next 2 or 3 days, TCS has already announced one. Now the criticism for IT companies for the longest time has been that they are not great capital allocators, they've been hoarding cash, that's the word which we've used, hoarding cash. Now they're giving the cash back, yet the stocks are not getting re-rated, the P multiples are compressed. Because of a buyback, and if the capital allocation gets better, P multiples should expand. Why is that? Why is that not happening?
I think because the concerns on growth remain.
Are they real?
I think to some extent, I would say that they could be real for the next maybe a year and a half. And especially for, the top 3-4 IT companies where they are huge in terms of their size, they are multi-billion-dollar companies and all of that. And clearly their conventional or the legacy business is at risk in terms of growth. So maybe that business won't go away, but getting growth on such a large multi-billion-dollar base is very, very challenging. So I clearly believe yet that growth is yet a concern for some of these companies, and that's why there is still not a re-rating. But if you kind of really look at, say, how the rally has played out in the marketplace, and we moved from 8,000 to 9,000 on the Nifty, I think some of these stocks have also appreciated by 10-12% from their lows that we had seen in end December or early January. So to some extent, the market has started kind of, in a way, rewarding them for initiatives like the buyback. And we have to keep in mind, and I think from an Indian context, I think buyback itself is going to be a huge trigger or a catalyst for the markets. If you look at the US, over, say, a 3 year time frame, I think the buybacks have been more to the tune of something like $1.5 trillion. That's huge. And that has been one of the contributors to the global rally in equity. I think in India, we are seeing, buybacks start off in a very significant way by the PSUs, now by the technology companies. And I think overall, you would see buybacks becoming a more generic kind of a thing where a lot of players who are cash rich resort to buybacks. That itself could contribute to some bit of EPS growth over a 2 to 3 year time frame.
Point. Apple has done a buyback, IBM has done a buyback, global pharma companies also doing a buyback. Yes. So the aggregate earning EPS or the earnings picture will change because of that. So let's look at sectors where there is, maybe news is not great, but the bounce back has been incredible, and that's metals. Exactly a year ago, we were disturbed because of China, because of Europe, we were talking about confusion and chaos in emerging markets, and yet metal stocks have rallied.
Yeah, and I think that's what it does. I mean, markets tend to kind of, in a way surprise you. And I think the metal stocks were so beaten down a year back that I think stocks beating down significantly, and then of course commodity prices, rallying to some extent from those lows a year and a half back. I think both have contributed to that. And of course, apart from that, falling interest rates and things of that kind. But we have to keep in mind, I think that you're going to see a huge divergence in the global marketplace. I think by and large, conventional wisdom said that when the dollar is strong, commodities do not rally. But I think over the last year or so, I think you've seen a situation where both the dollar has been strong and the commodity prices have rallied. Similarly, the conventional wisdom says that when you see interest rates getting hiked, typically equities as an asset class may not do as well. But it's again, you're seeing a divergence that interest rates are getting hiked, and the market is in a way not even concerned that the US Fed has given a guidance of 2 more rate hikes during the rest of the year. So you see some of these divergences play out. But having said that, now I think by and large I don't see a significant upside in metal stocks, and that's purely because the reality is that they remain cyclical businesses. And I think if the moment you see a 5-10% correction in commodity prices, you could actually see even a bigger impact on some of these metal stocks or commodity stocks. So my sense is, yes, I think it's a fantastic rally which is played out, and I think somebody who could really have taken that call a year back, I think it's been fantastic for them. But I think I would be circumspect going forward in terms of really playing a metals or a commodities rally.
So what are you buying or selling in your portfolio?
So I think some of the mainstay remains. I think in terms of consumer, I think that remains, I think, the big thing. So going forward, the way, as I was earlier also referring to, this whole switch from unorganized to organized, I think has the potential to play out significantly by 2020.
Give me an example.
So I think the entire building product space, I think out there the opportunities are significant. I think housing itself, where of course that seems to be now becoming the flagship program, so to say, of the current government. And if you really look at the news flow from 31st December onwards, all the big announcements, I think there have been so many big announcements on housing. You could call that affordable housing or housing, but I think that's one space. And then with RERA coming in, it's a space which is going to get regulated, which means unorganized local players will find it very, very difficult to operate in this space. And I think that itself can be a significant opportunity. So the way I think a year back, maybe unconventional wisdom said go and buy metals, and I think very few people would have done it. I think maybe this time around something like that could be a great proxy to play.
So buy real estate stocks, as simple as that.
I think within that, I think the housing kind of companies, I think especially companies which are more towards the mid-income affordable housing, I think that's one segment to play out for. A good proxy to that would also be some of the cement stocks. I think they are expensive, but I think what we need to keep in mind that the capacity utilization still out there is yet 65 to 75%. So maybe over a 3-year time frame, if the housing activity picks up, then maybe cement is one great area to kind of look at. In addition to that, some of the other consumer companies, like say for example the apparel plays, the appliances kind of companies, they I think would be huge beneficiaries of some of the other things like say the digital economy kicking in, direct benefit transfers kicking in. I think a combination of all of these, be it digital, demonetization, GST, direct benefit transfers, I think all of this, or the Ujjwala scheme, I think all of these put together, I think really make a good recipe for some of these consumer companies to kind of play out over the next 3 to 4 years.
We've always argued that you should sell PSU banks and buy private banks. And for those who followed this simple trade of value migration where PSU banks were losing market share, private banks were gaining market share, they've made serious money.
Yes.
But is it time to reverse now? Because if the economy picks up, PSU banks will also recover.
I think the biggest challenge for PSU banks yet is going to be capital. The asset quality woes continue. We really don't know how long that will still last. It's quite possible that this quarter or this financial year could be really the end of the asset quality woes, and probably after that you would not see deterioration and maybe a gradual improvement. That's, I think, a best case scenario. But the challenges of capital remain. And I think the only solution for that, or an important solution for that, is if the government will use this political capital to basically go ahead and reduce its holding below 51%. I think if that were to happen, my sense is PSU banks would become a significant play. So one is capital, and two is of course some of the softer issues in terms of talent and technology and their ability to go out and woo the new middle class consumer and grow the retail business in a more effective manner. So my sense is that I think if these two challenges get addressed, then maybe there is a play in PSU banks. But as long as these two things do not happen, my sense is that the private sector banks will continue to outperform. So that's one. Two is maybe the other way to play it is really to look at the entire NBFCs, the people who lend out to the unorganized sector, the MFI space, the HFCs. So that's the second pack out there. That also continues to be a very interesting play. So my sense is a combination of the private sector players as well as some of the new private banks as well as some of the private lenders. I think that is a good combination to really look at till the big bang reforms on the PSU banking side do not happen.
PSU banks in general have done very well of late, whether it's metals, energy, banks, even a name like Engineers India, BL, BML. None of the PSU companies have anything in common. I mean, there is no correlation between NTPC and EIL. Yet PSU as a cluster has been an outperforming cluster. Why is that?
I think there are multiple reasons for that. One is, of course, I think they were beaten down a year and a half back. I think they were beaten down. So that was the starting point, which means that the price points were relatively attractive, number one. Number two is, I think some initiatives like buybacks, higher dividend payout, I think have contributed it. For some of them, the business itself has improved. So whether it's an engineering company or whether it's a metals company, I think the business outlook itself has turned better versus what it was 2 years back or 3 years back or 5 years back. So that has helped. And the fourth is that in some of the cases, there is basically a buzz about strategic sale. So some of the companies like you mentioned, BML or Dredging Corporation, out there are media reports which suggest that the government could kind of give off a controlling interest to a private player. So I think it's a combination of these four things: price, buybacks, better business outlook, and a potential strategic sale out. I think these four are the factors which I think have contributed to basically some of the PSU players outperforming the rest of the market.
And it's only when I start counting years I realize how old we are getting. Very early part of your career, you bought into Pantaloon. DMart has gone public. There was no song and dance when Pantaloon got created, but DMart has this entire, euphoric appeal. What do you make of DMart? I mean, when it goes public, is it like buying HDFC Bank? Just buy it and sit tight?
The difference was that I think when HDFC Bank went public, I think there were still apprehensions that whether HDFC Bank could be a roaring success or not. Of course, the HDFC brand was a great brand, but the bank, whether it would be a success or not, because I think we all Indians were used to basically parking our money or using the services of a public sector bank, and a government bank implied, safety and trust. And obviously, therefore, HDFC Bank in a way, I think has turned out to be a huge positive over the years. So I think in the initial phase, I think HDFC Bank was a relatively less celebrated story, so to say. And then, of course, now there's been a 20-year track record of, growing at 20% odd over a 20-year time frame. I think here, this is already a significantly celebrated story in a way. And that's also reflected from two things: the kind of valuations at which the IPO is happening and the response to the IPO. I think both these factors already reflect the kind of expectations which have already built in.
It's a carnival feeling.
Exactly. So I'm not quite sure whether these are the right valuations to invest in, but I think if you necessarily want a retail exposure, then maybe DMart probably is the best exposure to have, because I think in a way it's been able to kind of evolve a capital efficient model. It doesn't mean that it does not require capital, but I think somewhere versus or relative to the other players, it's been able to evolve a more capital efficient model, which has helped it to grow. I think its size is significant. I think it's got a long runway of growth because it's just present in 2 or 3 states in a significant manner. It yet has to kind of enter into many other states of India. So in a way, I'd say that the runway of growth, I think, is significant for not just the retail as a sector, but I think for DMart as a leading player in the sector.
I met Howard Marks 15 days ago, and what I learned from him was that when an asset class gets a good nickname, you should avoid it. When an asset class gets a bad nickname, you get it at a throwaway price. So which is one asset class or group in this market is getting a good nickname? Either it's priced to perfection, is overpriced, and vice versa.
I think on one hand, fixed income, I think by and large, the best is over in terms of the interest rates where they are. We're already at 6.5%. inflation will remain at 4 to 5%. So I think clearly fixed income has had a good time in the last 2 years. And my sense is that by and large, that party is over. I think in terms of the contrast space, maybe right now, the complete beaten down space in terms of asset class is real estate. I think
physical real estate.
Physical real estate. But I think, of course, always when we know that, when an asset class is beaten down, I think if you play it through equities, I think the returns are relatively better.
You're making a strong case. Second time in a 25-minute conversation, you've said buy real estate stocks.
I think by and large they are beaten down. Of course, of course, I think if you really look at it over the last 2 months, they've done extremely well from those lows and all of that. But I still think they have a lot of ground to cover. I think.
So the real estate stocks you own, have you doubled them up? Have you added more at lower levels?
So we have added them added more of them at the lower levels, and I think there's a lot of ground to cover. So it's like, again, I get back to metals a year back, that nobody would have really, it would have been difficult to bet on metals a year back. But I think the fact that the government went ahead, put anti-dumping duty on steel and all of that, I think really helped a lot of the metal stocks in India.
Would you say that with IT? It's got a bad nickname right now.
Yes, but the valuations are not yet as cheap. I mean, they are cheap. They're in the teens, but they're still at, those 16, 18 times. Are they at 10, 12 times? The answer is, no. Number two, is there any kind of repair to be done in terms of the balance sheet repair? Answer is no. They have fantastic balance sheets. They have fantastic management quality. Whereas on the other side, I think there is balance sheet repair to be done. Valuations are more attractive, and their ability to kind of report, say, a high double-digit earnings growth over the next 2-3 years is still very high. Whereas I think for the IT, it's going to be tough for them to kind of report high double-digit earnings growth.
Okay.
So I think that's the difference. That doesn't mean you can't make returns in IT, but I'm just saying is if you were to kind of make an outlierish call, I think it would be more about some of these housing stocks versus technology stocks.
2-3 years ago when I advised friends to buy equities, it was a laughable comment. Now I'm getting a reverse kind of a scenario. Some of our viewers, some of my friends, relatives now, they approach me and they ask me, look, I want to invest 10 lakh rupees in stock markets. That 10 lakh rupees is lying in fixed deposit, which is giving me 5 or 6% taxable return. Should we buy in one shot? Should we do an SIP? And I don't know how to answer that question sometimes, because if I tell them to put all the money at once, then there is a risk which could just haunt us. If I tell them to wait for a big correction, I don't know when the big correction would come.
So I think SIP is good for all seasons, and I think SIP typically you would want to do it out of your regular stream of income. So if you're having a particular stream of income, within that you kind of pull out some piece and put it into SIPs, and I think so that's that. But if you have accumulated savings, accumulated wealth, and you really need to make some chunky investment, I don't think it's a bad time to kind of really kind of put there, provided if you are looking at fixed deposits or bonds with a 5-year horizon, then give that same time horizon to equities.
Because you're sounding bullish.
Right.
You're sounding bullish, your models are indicating that better
Right.
days are coming.
Yes.
That's a basic premise for
Yes.
you're bullish.
Yes.
So where can you see that opportunity? What is that edge which you have, which others don't have?
So I think our clear big bet that we are making right now is that by and large, the long extended period of single digit earnings growth is over.
Yeah.
And we think that basically we are entering into a long extended period of double-digit earnings growth.
So you're betting on earnings recovery?
Absolutely.
Okay, I was looking for that answer. When I started the show, maybe I was unsure as to what kind of answers I would get, but Nilesh Shah, always a pleasure to have you, and loved your positive tone, how well you've simplified why one should remain bullish.
Thank you. Thank you,
very much for
Nikunj.
joining us. That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.